Broker has a pitch. Now you get a CPA. I want you to picture this. You found a laundromat listed at $300,000. You've saved $80,000. The broker tells you that an SBA loan, you could put down 10%, that's $300,000, and finance the rest. You got $80,000 saved, $30,000 down. Hey, you're thinking you have more than enough, then you can close the deal. And somehow between the closing table and the first 90 days of ownership, you realize that the $80,000 you started with is almost entirely gone, and the business hasn't paid you a single dollar yet. This happens all the time, not because buyers are bad at math, but nobody showed them all of the math. The asking price is one number, right? The true cost of buying a business, well, that's completely a different number, and it's always higher. Today, I'm going to show you every component of that number, how to calculate it for any deal you're looking at, and what happens to buyers who skip this calculation. I'm Jason Schmidt, a CPA, and this is the first video in the Money Math series, the financial framework that protects buyers under $500,000 once they find a deal worth pursuing. If you want to talk to me and other business buyers, please join my free community, Firewatch Business Lab, on school.com. It is free, and we are looking at deals right now. Now, if you're new here, go back and watch the Business Buyers Playbook series first, okay? 6 videos that cover everything you need to know before you have the money conversation. Link is right here on the screen, and the playlist is on my channel page. If you already watched those videos, now let's talk about the real math. Here's why this miscalculation happens so consistently. The listing shows you an asking price. The broker walks you through the financing structure, typically an SBA 7A loan, with a 10 to 20% down payment. You do the math. You check your bank account. You decide, I can afford this. What the broker isn't walking you through and what is not in the listing is every other dollar that has to leave your account between now and the day the business starts paying you. There are 5 categories of costs beyond the down payment. Every single one of them is real. Every single one of them is necessary. And together they routinely add up to between $30,000 and $80,000 to what you actually need. I'm going to walk you through each one, okay? The first category is the one buyers do calculate the down payment. For an SBA 7A loan on a business acquisition, the standard down payment is 10% for deals with strong collateral and cash flow, and up to 20 to 30% for deals that do not qualify at the 10%. Okay, on a $300,000 business, that's $30,000 to $90,000, depending on how the deal is structured. Here's what most buyers don't know about. Their down payment covers the purchase price only. It does not cover anything else we're talking about or we're about to talk about. That $30,000 goes to the seller. The bank account goes down $30,000. And now you own a business and you still need cash for everything that comes next. The down payment is the entry ticket, right? It's the greens fees. What follows is the actual cost of operating. The second category is closing costs and transaction expenses. That is the first place buyers go, wow, I got surprised. I didn't know that was coming. Right now, some of you are saying, this is so basic, but you would be surprised how many business buyers don't understand it and don't look at it. Okay, SBA loan fees. The SBA charges you a guarantee fee on the guaranteed portion of the loan. On a $270,000 SBA loan, your $300,000 purchase minus your $30,000 down payment, the guarantee fee can run between $6,000 and $9,000, depending on the loan size and the terms, obviously. This is real cost that comes out of your pocket at closing unless you roll them into the loan. Attorney's fees. You need a business acquisition attorney reviewing the purchase agreement, the asset documents, the lease assignment. Expect $3,000 to $8,000, depending on the complexity. And don't forget about the CPA fees. If you don't already have a CPA reviewing the financials and the deal structure, well, you need one. Expect $3,000 to $5,000 for a proper financial review of the deal. Now let's talk about title and escrow fees. between $1,000 and $3,000, depending on the state and the deal structure. How about a business valuation? For any purchase over $200,000, an independent valuation is strongly recommended. I promise you need it. That's between $1,500 to $5,000. And those add up on a deal that you're spending $300,000 on a laundromat. And you're looking at $13,500 to $30,000 in transaction costs alone before you paid anything operational. These costs are almost never discussed. They're never discussed in the broker's initial conversation with you. They exist on the closing disclosure document. And by the time you see the closing disclosures, you're already emotionally committed to that deal. The third category is the one that does the most damage to buyers who don't plan for it, and that's working capital. Working capital is the cash you need to operate the business from the day you close until the business cash flow is reliably covering its own expenses. It's your operating runway, right? Here's why this matters so much. When you buy a business and take over operations, there's almost always a period of adjustment. Customers may not even know the ownership has changed. Vendors may be on different payment terms than you expected. Maybe equipment now needs your attention. Revenue in month one may be lower than your pro forma suggested simply because of the friction you get from the transition to you. The standard recommendation is 3 to 6 months of operating expenses held in reserve. Now, back to our laundromat deal, right? For a laundromat running $15,000 per month in total operating costs, right? That's $45,000 to $90,000 you need in reserve. Now, you're not supposed to spend this money. It exists to prevent a cash crisis in the early months from killing a business that would otherwise be fine. Think of it as a safety net. You never want to touch it, but you can't afford not to have it. Most buyers don't have it. They close the deal, they deploy their savings on the down payment and closing costs, and they almost never leave enough as a buffer. Then month 2 comes, the revenue is 15% below projection, and you have no runway to absorb it. This is how good businesses fail in new ownership. The fourth category is equipment repairs and immediate capital needs. Okay. And this is deal specific, and it's always present. Your due diligence process that I gave you in the checklist, I gave this to you in video 5, should have identified every piece of equipment that needs replacement, repair, or service in the near term. If you've done your homework properly, you already have a number there. If you haven't done your homework, you will find out this number after you close, which is the most expensive time to find out. On a laundromat with aging equipment, you might have $15,000 in deferred maintenance. That needs to be addressed in the first 6 months. On a car wash or service business, it could be higher. On a well-maintained operation, it could be minimal. You just don't know. This number belongs in your pre-offer calculation, right? You must identify it during your due diligence. Add it to your total cash requirement, your 90-day runway. And if it's significant, use it to negotiate the purchase price down. A seller who knows the equipment needs $20,000 in work is usually willing to reduce the asking price by at least that amount to keep the deal on track. Okay, the fifth category is one that nobody talks about and the one that surprises the buyers the most, really, and that is the 90-day cash flow gap. Here's the reality of buying a business that's existing. The business earns cash flow, but the cash flow doesn't start paying you immediately. There is a typical 60 to 90-day period where you are learning the business, stabilizing operations, handling the transitions, and reinvesting cash flow back into the business before you can reliably take a distribution. During those 90 days, you still have your personal expenses. You've got a mortgage you got to pay or rent. You got your car note. You got to eat. You got to go buy groceries, your family bills. None of those stop because you bought a business. If you planned to replace your personal income immediately with the business's cash flow, you have created a cash crisis on day one. The business earns $8,000 a month in SDE, but you only need $7,000 a month personally. And for the first 90 days, that $8,000 needs to stay in the business. The buyers who survived this period are the ones who had 90 days of personal living expenses saved separately from their business capital. Okay? Not combined, separate. Personal runway in addition to the business's working capital. So that's another $15,000 to $25,000 for most buyers on top of everything else. Okay, let's look at this. Let me put all 5 categories together on a $300,000 laundromat so that you can actually see a number, right? Purchase price, $300,000. Down payment at 10%, $30,000. SBA guarantee fee and loan cost, $8,000. Professional fees from an attorney and CPA and evaluation, $12,000. Equipment repairs identified during due diligence. I cannot stress that enough. During due diligence, you found $15,000 worth of equipment that needed to be repaired. Now you have your working capital reserves of 4 months, which is $60,000. Personal living expenses for 90 days, $20,000. Your total cash requirement is $145,000. You needed $30,000 for the down payment. You actually need $145,000 to actually buy the business safely. This is not a worst case scenario. This is a realistic, well-prepared buyer on a straightforward $300,000 deal. Now ask yourself, when you looked at the business and decided you could afford it, which of those 6 numbers did you have in your calculation? This is not meant to scare you away from buying a business. It's meant to scare you away from buying a business undercapitalized. Because undercapitalized businesses and undercapitalized buyers are the ones who fail. Not because the business was bad. It's because they ran out of runway before the business had a chance to prove itself. Here's what you do with this framework, okay? Before you make any offer on the business, on a business, build your own version of this calculation. Use the actual numbers from the deal you're looking at. Get real quotes from professionals on the professional fees. Calculate your working capital requirement based on specific operating costs of that business. You've seen the P&Ls. You know what those are. Add your personal living expenses for 90 days. That number is your true capital requirement. Compare it to what you actually have available liquid. Not in retirement accounts, not in your 401k, not in a home equity that you haven't tapped yet. Liquid cash you can deploy. If the gap between what you have and what you actually need is too large, that's not a reason to give up on business ownership. No, it's a reason to look for a smaller deal or to negotiate the seller financing that reduces the SBA loan amount, or maybe you need to bring a partner in. These are solutions. But you have to know the real number first. The buyers that get themselves in trouble are not the ones who discovered a gap and problem solved. They are the ones who never ran the real number and discovered the gap at closing when it was too late. If you want to run this math on a specific deal you're looking at, bring it into the Firewatch Business Lab on school.com. It's free to join. The link is in the description. Drop your numbers in the community and let's look at it together. And if you're at the point where you need a CPA's eyes on the full picture, the asking price, the financing structure, the working capital requirements, the due diligence findings, you can book a discovery call with me in the Firewatch Business Lab on school.com. Listen, that's exactly what I do. Again, the link is below. If you want a deep dive into SBA loans, specifically on who actually qualifies, what the real requirements look like beyond what the brokers tell you, and the mistakes that get loan applications denied after buyers have already made an offer. If you're counting on SBA financing to buy your business, do not make an offer before you watch this next video. Remember, it's not about finding a deal, it's about avoiding a bad one.